Hello everyone, today is Tuesday, February 24th, 2026. Hope everyone is doing well mentally and physically. Welcome to another episode of Tax and Accounting Ride Along, brought to you by Sands Virtual Enterprise, LLC, your go-to dose of straight-talking tax and accounting insights for small businesses and the everyday taxpayer in the general public. Today, this episode might be especially for you and can put some money back in your pocket. Our discussion centers around a popular tax myth that all early distributions or withdrawals from a Roth IRA account are taxable simply because you may be under 59 and a half years old. This is simply not the case. Let's take a deeper dive into this. So without much further ado, let's crank it up and get straight to it.
Have you ever noticed how we just, blindly trust certain people with our lives?
Oh, absolutely.
I mean, really think about it. You hand your car keys to a valet without asking if he actually knows how to drive a stick?
Right. Or a surgeon. You just assume they did well in med school.
Exactly. And maybe most dangerously, you hand this stack of W-2s and 1099s to a tax professional and just assume, hey, they've got a calculator. They must know what they're doing.
It's a very human thing to do. Psychologists call it the appeal to authority bias. The tax code is this massive, terrifying beast. I mean, it's thousands of pages long.
It's like magic to me.
So we just assume that anyone who hangs a shingle saying tax preparer has this mystical knowledge that we don't.
Right. I just sign where the sticky note tells me to sign. But here's the terrifying question we're starting with today, based on the documents you brought in. What if that blind trust is actually costing you thousands of dollars? Specifically, what if you've been told that all early Roth IRA distributions are taxable? You paid the IRS without question, and you were just dead wrong.
It sounds like a conspiracy theory, doesn't it? Like something you'd read on some dark corner of the internet.
It really does.
But we are looking at a very reputable guide today. It's titled, Did Your Tax Pro Botch Your Roth IRA Distributions? It's produced by Sands Virtual Enterprise, LLC.
Okay.
And the premise is startlingly simple and, well, scary. There is a massive blind spot in the tax prep industry about Roth IRAs, and if you've taken money out early, you might have been a victim of it.
Victim is a strong word. But when I looked at the numbers in this guide, and we're going to get to the math, folks, and it is going to make you wince, it felt right.
Yeah.
We're not talking about $20 here, not a rounding error. We're talking about massive penalties, unnecessary taxes that could fund, a decent used car. A dream vacation.
Exactly. So the mission for this deep dive is to unpack a very specific, very costly error. We need to understand the mechanics of why professional tax preparers,
people we pay hundreds of dollars to,
people we pay to know better, mess this up. And crucially, we need to look at the good news the source offers. The potential for a refund.
But there's a ticking clock on that refund, which we will get to. It's not an open invitation.
Right.
So first, let's set the baseline. Most people know the golden rule of retirement accounts. Don't touch the money till you're 59 and a half.
Don't touch it.
If you do, the IRS slaps your hand. That's the common knowledge, right?
That is the common knowledge. It's drilled into us from the moment we open our first 401k. The IRS puts up a velvet rope, and if you cross it early, you pay the bouncer.
And that bouncer is what, like a 10% penalty?
Usually a 10% penalty plus income tax, yeah.
So if that's the rule, how is the source claiming that tax pros are botching it? I mean, if I take money out at age 40, shouldn't I be taxed? Fair is fair.
And this is where we have to get a little technical, but this is also where the aha moment happens. The source argues that while the general rule is early equals penalty, the Roth IRA, it operates under a completely different set of physics than a traditional IRA or a 401k.
A different set of physics.
And the mistake happens when a tax pro treats a Roth like it's a traditional account. They're applying the rules of football to a game of basketball.
Okay, let's break that down. What's the fundamental difference they're missing? Because to me, an IRA is an IRA.
It comes down to one magic word: basis.
Basis. Okay, define that for us in plain English.
Basis is simply the money you contributed. The cash you took out of your paycheck, paid your income taxes on, and then deposited into the Roth.
Okay, so money I've already been taxed on.
Exactly, because you have already paid taxes on that principal. That is the key. The IRS generally lets you take that specific amount back out, tax-free and penalty-free, at any time.
Wait, Waz, at any time? Even if I'm 30 years old?
Yeah.
Even if I just put it in last week?
Yes. And this is the crux of the whole thing. The text explicitly says Roth IRA distributions aren't always taxable. If you withdraw your basis, your own contribution,
My own money.
your own money, there should be no tax and no penalty. The penalties only kick in when you start touching the earnings.
The profit.
The profit that money made in the market. Yes.
Okay, I want to make sure I really get this because this feels like a cheat code.
Yeah.
Let's say I put $50,000 into a Roth over 10 years.
Okay.
That account grows to $70,000 because, I invested well, I have an emergency, the roof caves in, and I need to take out $20,000.
Okay. In that scenario, you are withdrawing from your basis. You put $50,000 in, you're taking $20,000 out.
Right.
You're only taking back your own cash. You already paid taxes on that 20 grand years ago when you earned it. So you take it out, the tax bill should be zero, the penalty should be zero.
Zero. I like that number. But the source says this is a common mistake. So same scenario. I take out my own $20,000. What does the bad tax pro do?
The bad tax pro, or let's be charitable, the rush, overworked tax pro, sees two things on your paperwork.
What are they?
They see a withdrawal of $20,000 and they see your birth date. They see you're under 59 and a half.
Wow.
Their brain or their software just defaults to the traditional IRA rule. Early withdrawal detected. Apply 10% penalty. Add to taxable income.
So they're literally taxing me on money I already paid taxes on.
Precisely. It's double taxation. You paid tax when you earned it, and now you're paying tax to access it, plus a penalty for the privilege. And the source calls this the age factor.
That is incredibly frustrating. It feels lazy. It feels like they're not actually looking at my specific situation.
It is lazy, but it's also systemic. The source highlights that this happens because preparers make a lazy assumption. They don't dig into the conditions.
They don't look at the history of the account.
Right. They don't look to see what that money represents. They just see distribution and young, and they hit the panic button.
It's like a doctor prescribing antibiotics just because you coughed, without checking if it's viral or bacterial.
That's a perfect analogy. And the source points out this isn't just about incompetence, it's also about complexity. The text mentions complex early Roth IRA withdrawal rules.
Cool.
There's a specific ordering rule that IRS follows. Think of your Roth IRA like a layer cake.
I love cake. Go on.
The top layer is your contributions, your basis. The next layer might be conversions from a traditional IRA. The bottom layer is your earnings, the growth.
Out it.
When you take a scoop out, the IRS says you eat the top layer first, you take your contributions out first, and those are tax-free.
But if the tax preparer doesn't know that,
If they think it's all just one big blended smoothie, they tax the whole thing.
and the client, the listener, is the one writing the check. Let's talk about the damage here. The source uses the phrase unnecessary taxes and penalties, which sounds a bit polite. Can we put a hard price tag on this mistake?
Absolutely. Let's stick with your example. You withdrew $20,000 to fix your roof. If the tax pro botches it, first, you get hit with the 10% early withdrawal penalty.
Yeah.
That's $2,000 gone immediately.
Ouch, that's a new sofa. Gone.
But it gets worse. If they treat that $20,000 as taxable income, it gets added to your yearly earnings. So let's say you're in the 24% federal tax bracket.
All right.
You now owe another $4,800 in federal income tax. And that's not even counting state taxes.
So on a $20,000 withdrawal, I'm paying, let me do the math, $2,000 plus $4,800. That's $6,800.
$6,800. Roughly 34% of your money evaporates. And remember, in our scenario, that was your money, your basis.
I owed zero.
You owed zero. So that is a $6,800 error.
That is, honestly, that makes me feel sick. Because usually when people make an early withdrawal, it's not because they're buying a yacht.
No.
They're in a pinch.
Yeah.
They need that cash for a medical bill, a layoff, a big life event.
Exactly. You're kicking someone when they're down. And the source material really leans into this. It talks about letting errors take a bite out of your savings. It's not just a math error, it's a loss of security.
And it's a loss of future wealth, too. We talk about compound interest all the time on this show.
Right. That's the opportunity cost. If you pay that $6,800 to the IRS unnecessarily, that's $6,800 that isn't growing for your retirement.
Wow.
Over 20 years, I mean, that single mistake could be worth $30,000, maybe $40,000 in lost growth.
So the stakes are massive.
Yeah.
Okay, so we've established the expert trap is real. They rely on age, not the rules. We've established the cost, thousands of dollars. Now, the source material pivots. It doesn't just leave us in despair. It talks about a good news scenario.
Yes. And this is the part where listeners need to turn up the volume. The source states, you could be eligible for a refund.
Eligible for a refund, so we can go back in time.
In the tax world, yes. It's called an amended return, Form 1040X. If you can prove your tax pro botched the Roth distribution,
That they taxed your basis.
that they taxed your basis when they shouldn't have, you can file a correction. You essentially say, oops, we overpaid you. Please send that check back.
That sounds great. Who doesn't want a check from the Treasury? But then the source drops the hammer. There's a warning, right?
A very strict warning. Tax refunds for overpaid Roth IRA withdrawals don't last forever. That's the quote.
So there's a statute of limitations.
There is. Generally, for federal taxes, you have a 3-year window from the original filing deadline to claim a refund.
So if I made this mistake in, say, come 15, I'm toast.
Most likely, yes. That money is gone. The government has closed the books. But if you made this mistake in 2021, 2022, or 2023,
The window might still be open.
it might be.
Really?
But it is closing every single day.
That is the call to verification the source urges. Don't wait too long to check your tax filings.
It's basically telling you to stop what you're doing and go look at your old returns right now. But here's the problem, and the source acknowledges it. Have you ever actually looked at a Form 1040? Or specifically, Form 8606, which handles these things?
Oh, I have. It looks like hieroglyphics. I see boxes, lines, codes, references to line 15B from worksheet C. I have no idea what I'm looking at.
And that is why the do-it-yourself approach is so risky. Even if you suspect a mistake, do you know how to prove your basis? How to reconstruct your contribution history from 10 years ago?
No.
How to fill out the amendment correctly so you don't trigger an audit? The source notes, these rules are complex. It's a maze.
And this is where the source introduces the guide. Sans Virtual Enterprise,
Yeah.
LLC. We need to talk about them because the text positions them as the solution.
Right.
They aren't just a generic tax shop. The source says they specialize in fixing Roth IRA tax errors.
That word specialize is doing a lot of heavy lifting there. And it's important. I mean, if you have a brain tumor, you don't go to a general practitioner.
You go to a neurosurgeon.
Right. And the source is arguing that this is a neurosurgery level tax event. Generalists mess it up because they're doing general work. Specialists fix it because they know the anatomy of the problem.
What exactly does the text say they do besides just fixing it?
Well, they list 3 key things. First, they navigate the complex early Roth IRA withdrawal rules. They figure out the ordering basis versus earnings.
Okay.
Second, they help recover what you've overpaid, so the refund. And third, and I think this is the most interesting one, they ensure the client isn't caught in the same trap again.
That suggests an educational component, or at least setting up your files so next year isn't a disaster too.
Exactly. If you establish your basis correctly this year, it makes future withdrawals much smoother. You're creating a record. The source directs people to your website, svv-accountingandtaxes.com, basically offering a lifeline.
And the phrasing they use is powerful.
Yeah.
Get what's rightfully yours.
That resonates, doesn't it?
It really does. It reframes the whole conversation. This isn't about tax evasion or some shady loophole. It's about property rights. That money in the Roth, the basis, is yours. You already pay tax on it. The government has no right to it.
That is the philosophical underpinning of the Roth IRA. You pay the tax up front in exchange for freedom later. When a tax error violates that freedom, well, you're being deprived of your property.
So don't let a clerical error rob you.
That's what the source is saying.
I want to play devil's advocate for a second. We've been pretty hard on tax pros here. Is it possible the source is exaggerating how common this is? Are we just scaring people?
It's a fair question, but, consider the incentives. Most tax preparers work on volume. Think about April 10th. They're buried in paper.
Oh, yeah.
They're churning through hundreds of returns. They're using software designed for the 90% use case. The Roth ordering rules are an edge case. They require manual calculation tracking basis from years ago.
Which means they require time. And during tax season, time is the one thing they don't have.
Exactly. So it's not that tax pros are evil or stupid. It's that the system is built for speed, not nuance. And that speed leads to the age factor assumption. It's a shortcut. And shortcuts lead to accidents.
So if I'm listening to this and I'm thinking, I took out money for a house down payment 3 years ago, what should I be looking for on my return? Give me the detective kit.
Okay, open your tax return. Look for Form 8606 if it's there, but simpler than that. Look for the line on your 1040 for IRA distributions.
Okay.
If you withdrew, say, $10,000, and the line next to it says taxable amount, $10,000, and you know you contributed at least that much over the years,
You have a smoking gun.
that is a clear red flag. Unless you withdrew more than you contributed, that taxable amount number should probably be 0.
And if I see that red flag,
The source says, act now, don't sit on it, don't say, oh, I'll get to it next summer. That clock doesn't start ticking just because you realize the mistake.
this is making me rethink how I view my old tax returns. I would just, file them away and forget them.
But we shouldn't, especially with retirement accounts. These things span decades. A mistake in year 5 can haunt you in year 25 if the basis isn't tracked.
So we need to shift from filing to managing.
Exactly. It's part of managing your own wealth.
Let's circle back to the specialist solution for a moment. Why can't I just go back to the original person who messed it up and say, hey, you botched this, fix it?
You certainly can. But think about the psychology there. You're asking the person who made the mistake to admit it, understand a rule they evidently didn't, and then fix it for free.
It's an awkward conversation.
I know.
And they might just double down. No, the software says it's taxable. You're under 59.
Precisely. The source implies that going to a specialist, someone who wakes up every day thinking about these codes, just removes that friction. They know what they're looking for.
Is the difference between asking the cook who burnt your steak to recook it or just going to a different steakhouse?
A bit harsh, but accurate. Sometimes you need a fresh set of eyes.
Okay, let's talk about the refund again. Found money. What does that actually look like? Is it a credit?
Usually it's a check, a physical check from the U.S. Treasury. And here's a little bonus fact the source alludes to. Interest.
Wait, interest? The IRS pays me interest.
Yes. If the IRS held your money in error, they generally have to pay interest on the overpayment when they refund it. So you get your money back, plus a little, sorry, we held this bonus.
That is the best kind of sorry. So we have unpacked the problem. The age factor leads pros to assume taxes are due.
Right.
We've unpacked the cost, thousands in penalties and taxes. And we have unpacked the solution, checking past returns and maybe using a specialist like Sans Virtual Enterprise to file for a refund before the window closes.
That's a solid summary, but I think there's a deeper layer here. This deep dive is ostensibly about Roth IRAs, but if you zoom out, it's really about the hidden cost of bad advice.
Right.
The source proves that standard operating procedure is often wrong in nuanced situations. It makes you wonder, where else are we just accepting the default setting?
That is a scary thought.
Think about insurance, investment allocations, legal contracts. We rely on experts, but experts rely on shortcuts. In this case, the shortcut was young equals taxable. What's the shortcut your financial advisor is using?
You are making me paranoid. I'm going to go home and audit my entire life.
Well, a little paranoia can protect your wallet. The lesson here isn't to stop trusting professionals. It's to stop trusting them blindly. You have to be an active participant. You have to ask the question, why?
Why is this taxable? Why is my premium this high?
Exactly. If the tax pro had been asked, why is this taxable if it's my own contribution? They might have paused. They might have looked it up. But if you don't ask, the error slides right through.
So be the squeaky wheel.
Be the squeaky wheel, because in this case, the squeaky wheel gets thousands of dollars back.
And we like refunds.
Refunds are excellent.
So here's where we leave it for today. The source material. Did your tax pro botch your Roth IRA distributions? Lays it out pretty clearly.
Yeah.
The myth is that all early withdrawals cost you. The reality is that tax pros make mistakes, and the urgency is that the clock is ticking.
And remember, the resource mentioned, sve-accountingtaxes.com. They're the ones flagging this and offering a roadmap to fix it.
Right. So here's my challenge to you listening right now. If you have ever taken an early distribution from a Roth IRA, ever, and you paid taxes or penalties on it, go find that return.
Right now.
Dig it out. Look for Form 8606. Look at the taxable amount line and ask yourself, was that actually required, or did I just fall into the age trap?
And don't let the complexity scare you off. It's your money.
This raises the final provocative thought I want to leave everyone with. The text doesn't explicitly ask this, but it's the ghost haunting the whole document. If a professional can miss something so fundamental as a Roth IRA rule, what other standard financial advice have you accepted without question that might be costing you money right now?
That's the question that keeps me up at night. Are my investments actually in the right bucket? Is my estate plan actually valid?
It's the hidden cost of assumption. And today, we learn that costs can be thousands of dollars. Well, on that slightly paranoid but hopefully profitable note, we're going to wrap this deep dive.
Go check those tax returns.
Go check them. Don't let the window close on your money. Knowledge is power.
And in this case, it might be cash.
Well, folks, that's a wrap. Thanks for joining us for another episode of Tax and Accounting Ride-Along, courtesy of Sands Virtual Enterprise, LLC. Got feedback or curious questions? Or maybe a topic that needs some airtime? We'd love to hear from you. Connect with us at admin@sve-accountingandtaxes.com or text us at 404-5858513. Also, follow us on Facebook, Instagram, TikTok, YouTube, and LinkedIn for more insights. Catch you next time for more business talks and good times.